topic, planning considerations for business owners. You know, as a business owner myself, it can be an exciting, exhilarating, frustrating, terrifying, a lot of different emotions to being a business owner. And so the subtitle for the talk today, is it really any different? And that's what we're going to talk about today. So yes and no, planning is the same, but very different. And so what I'm going to do is take you through a series of slides today that essentially follow the CFP body of knowledge for the CFP curriculum. And so we'll go topic by topic, and we'll talk about those things that are different that you need to be aware of. Just wanted to mention this is a specialty that we have at Blue Sky, and it's something I've been working on for my whole career. So we don't expect you to be an expert in business owner planning after today, but what I've done is given you essentially a checklist of things to look for and be aware of when working with business owners, because it can be a really great market to work with. And I'll touch base on that as we go through why that is. First thing I want to do is kind of clear up something. What's in a name? So business owners get called a lot of different things: self-employed, entrepreneurs, business owners, things like that. These three stratifications are of my own making. You're not going to find this in a dictionary or textbook anywhere, but I generally view people self-employed or professionals, you know, doctors, lawyers, CPAs, chefs, you know, somebody, they turn a job into a business and are basically the main employee of the company, not a lot of enterprise value. The business owners, where I put myself in, they have a real passion for what they do, for the company that they're growing, and their objective is to grow it into something beyond themselves, something that will live beyond themselves. It has currently, when you're working with them, or will have significant enterprise value, and they typically view it as their baby. An entrepreneur, the last category, or someone that they may actually start multiple companies and are generally looking to make a lot of money, cash out of the business, take it public, something like that. And they generally grow kind of tired of running it after a while and are ready to move on to the next venture. That's important to keep in mind. Most of my presentation today is tailored towards that business owner. It will apply to both the self-employed and entrepreneur, but just keep that in mind. Is try to identify, you know, who you're working with, and don't just lump all business owners the same. So we'll start with those general principles of financial planning. Number one, data gathering. When you have a business owner, you need to change your data gathering questionnaire or whatever you do to include some additional things. Number one, financial statements. And this can be a huge problem area. A lot of businesses do not have good books, and it's almost impossible to tell what they're making or if they're making money, but you do need to get those and kind of learn what you're looking at. Obviously, business tax returns, not just the 1040, but I like to see those corporate returns, those LLC returns. You'll want to take a look at operating agreements, shareholder agreements, incorporation documents, bylaws, buy, sell, all those type things. Sometimes you'll ask for them and they can't find them. These are things that some lawyer may have done for them 10, 15 years ago. But you need to take a look at these, at least become familiar, read through them, understand what they contain. We're not asking you to become an attorney, but you want to be familiar with what is in an operating agreement. The 401k, pension summary, insurance, those are things you're going to collect from a regular employee as well, but we may get a little bit more detail for the business owner, especially on that 401k side. You want to know all the provisions in that. So moving on to goal planning, for a lot of business owners, the concept of, hey, I'm going to work here for 30 years, 40 years, and then retire, it really, they don't even understand what you're talking about. And so when you try to plug them into Money Guide Pro or something like that, they're going to have these wild goals, and they're going to conquer the world, and their company is going to be, you know, the greatest thing. We run into that a lot. Don't tell them they can't do that. Help them figure out what they need to do to reach it, and understand that they're not necessarily looking to retire from what they do. And that's not something that really is going to resonate with them. Now, some may be looking to sell and do that retire, but it's a different type of planning. Along with that, we find it very useful to sort of solve for the business income or sales price. What do I mean by that? So with a lot of people, you're planning, you say, okay, you work at this job and you're going to get raises, and here's your portfolio. You're going to make, 5, 6, 7% a year, whatever. And these are the things that you want to achieve in life. The business owner, sometimes they're going to give you these wild goals and you're like, there's no way you're going to be able to achieve that. And so what we'll do is we'll model a business sale or an income, and we'll come back to them and we'll say, okay, great, you want to do all these things. What you need to do is your business needs to throw off, $400,000 a year for the rest of your life, or you need to net after tax from this company, $5 million. So a lot of times that's the way to approach the planning, is solve that question for them. What value does their business need to provide, rather than looking at it today as to what it is providing? I always encourage my business owners to pursue a dual strategy, which is to become financially independent in the traditional manner. Hey, save a lot of money, keep your expenses low, accumulate a portfolio, stocks, bonds, real estate, those type of things. And then the second strategy is to succeed in business at or beyond those expectations. Moving on to cash flow, a lot of times they'll come in and their salary will be like $100,000, and they'll be living this huge lifestyle. And sometimes if you're not used to working with business owners, it can be hard to figure out where's all this money come from? And so I've listed here the 4 main areas: their salary, of course, those profit distributions, and then the non-cash benefits and those pre-tax lifestyle costs. And that can add up to a significant amount of money. These are some of the areas that you'll see people take out of the company that may not be obvious. They could be reimbursed tax-free for a home office, or the company could be paying for things in the home office. Vehicles are a big one. A lot of business owners have never had a car payment or spent a dime on their vehicles. Now that's a whole other thing on the tax deductibility of that, if they're doing it right or wrong. But for the most part, they're going to come in, if they have any sort of business they need to travel, and they're not going to have any vehicle expenses on their personal cash flow statement. Cell phones, travel. I mean, I can tell you, I never go anywhere. I try not to go anywhere without doing legitimate business when I travel. The computers, internets at home. This is one of my favorites, the Augusta rule, section 280A. You can rent your home for up to 14 days a year tax-free. And so a lot of business owners will do that. They'll rent it to their own company to have their annual meeting or something like that. And then, of course, the various executive perks. So there's a lot of ways that owners get money out of the company. When you're taking a look at their debt things, make sure that you're not just looking at their home mortgage and things like that. You've got to look at the company and see where they are in the company, the debt. And also, most of the time, unless they're a big giant company, they're going to have to sign a personal guarantee on a business loan. So if they take out a loan for a building for their company, or an expansion loan to hire new people or something, they're going to have to personally guarantee that. And so they may come in and they may not have a mortgage. We see that a lot. A lot of business owners, they'll get some money, they'll pay their house off, but they'll have a massive amount of personal guarantees out there on the company debt. So don't forget about that. Also, the business loans, that a lot of times they'll take a lien on the home. So they may not have a mortgage payment, but there may be a lien on the home. So make sure you're checking for that sort of things. You also want to take into economic considerations, even more so than an employee. While an employee may be affected, if they work in tech and there's a tech bubble, business owners especially are going to be hurt a lot more. Number one, economy in general, looking out for recessions. The industry they're in, I mean, look at what happened with Juul. The stroke of a pen, and a large percentage of their business just went away. Where are their facilities? California, we have clients that a client that had a winery in Napa Valley that was completely destroyed by a wildfire. And of course, here our home office is in New Bern, North Carolina, and Hurricane Florence hurt our little town really bad. And there are a lot of businesses that never recovered from that. So you got to take that into account. Political legislative changes. Anybody in the import-export business and all this tariffs going on, it's been kind of a wild ride. And so business owners generally need to keep larger amounts of cash reserves, and the economic considerations of what's going on in the world are going to have an outside effect on them. Here's one of my favorite ones, behavioral finance. I know a lot of you, study this and looking at the way investors look at their finances. For business owners, it's really important. Number one is just because they're a business owner doesn't necessarily mean they're a huge risk taker in their portfolio. Um, with a company, whether the reality is true or not, you feel like you have a lot more control over things. A lot of things are out of your control, but you do have control over some things. And so they're used to that control. And when they go into the public markets, it feels kind of out of control. And a lot of them are actually less risk tolerant than you would think. Also, I hear this sometimes like, what do you mean I'm going to put my money in stocks and bonds and only get a 6, 7, 8% return? I've been growing my company at 15, 20, 25%. Why would I do 8%? So just be ready to deal with that. They're also generally going to have that profit and loss business focus. They're used to analyzing numbers monthly or at least quarterly and making adjustments to their business. Like, let's say their profit margin, is normally 25% and it slips to 20%. Well, they're going to make adjustments to their company to get that back up. And so when it comes to the portfolio, sometimes they think they can do the same thing. Hey, we didn't make, we lost money this quarter. So what are we doing next quarter to tweak the portfolio? So it takes a lot of education sometimes in these areas when they're moving away from their business. Communication, kind of the same thing. Not that everybody isn't busy today, but business owners, I truly believe they can never leave it behind. Whether it's at work all day or at home, there's always business things going on, whether they're physically at the computer or on the phone with it, they're thinking about it. And they're dealing with a million things, payroll and employees and customers and vendors and things like that. Make sure you're giving them the bottom line up front. Do you need them to do something, or are you just giving them information? Do you need a decision from them? And always give them options with your recommendation. At the same time, make sure you give them a recommendation. I found that a lot of them are very receptive. If they're not an expert, they understand the concept of hiring experts and letting them and taking their advice. We've had a lot of success, remote conferences, shorter meetings, more frequent interactions. Unlike an employee that gets a job, unless it's open enrollment or they get a bonus or RSUs or something, it doesn't change from day to day. Business owners, that things can change very rapidly, so you want to have frequent interactions. Education planning, just one slide here on this. A great strategy for business owners is employ those kids for a legitimate purpose so they have earned income, and then have them fund their own college expenses. A lot of the business owners are not going to qualify for any sort of financial aid or anything like that. And so this is a great way to fund college at a much lower rate than having the business owner pay themselves a salary and then turn around and pay it to the college. I've also seen, just watch out for scholarships for children of employees, especially the owner. There's a lot of rules. You can get yourself into trouble there. All right, let's move on to risk management and insurance planning. Business owners, when you take a look at this area, there's a tremendous amount of risks. I've highlighted a couple slides here, some of those. Number one, debt. We've talked about this a little bit. General creditors. They may have signed guarantees, vendor agreements where they've obligated themselves to a year contract for a piece of software, something like that. All those credit cards that they issued out to the employees, more than likely, it's all tied back to them. And if an employee runs up $10,000 on that card and it's not paid, the owner is usually personally liable for that. So lots of areas there. Of course, civil tort liability revolves around who has the money. And let's be honest, no one is going to get sued if they don't have any money. And so the business owner is usually going to be named personally in a lot of these things. Autos and vehicles are extremely dangerous. If the company, construction, or anything that has vehicles, a lot of potential for liability there. I remember, in fact, when I was a teenager, I worked for a commercial landscape company, and I drove a truck, and some woman rear-ended me and turned around, and they actually sued the business owner for rear-ending one of her trucks. That she said the trailer hitch protruding from it that she ran into was unsafe. Anyway, of course, E&O, you want some professional malpractice. Make sure they're covering their professional malpractice. If they own the building, you've just compounded the number of risk exposures that they have, because not only now are they the landlord and all those liabilities that go along with being a landlord, but they're also the owner of the business that occupies it. Your business owner is usually going to be that trustee for the 401k, also a source of liability. Relationships, they may be in some partnerships, they may be co-signers, co-guarantors, they may have liability if they have partners. This is a really big one if there are multiple owners. We have a client right now that is in just a big giant mess because they have a partner in their business that's created all sorts of fiscal as well as legal liability for them. So you got to be careful of that. Of course, the employers, most employers are going to be somewhat liable for the activities of the employee if they're conducting in the scope of their business. So you need to make sure you're covering that risk. Employment practices, all the harassment, discrimination, things like that. Even if it's an employee in the company, the owner and the firm is usually going to get dragged into it. Then, of course, the last one, not to minimize this, but regulatory compliance risks are huge. If you're in a regulated business like us, investment advisors, medical, those type of things, the regulatory and compliance risks are huge that could put you out of business or subject your firm to fines and judgments. And of course, tax liabilities. I've heard stories, we don't have any clients, but I hear them all the time about owners getting in trouble for not paying tax. It's usually payroll taxes or self-employment taxes. They didn't realize, oh, that $500,000 I made, I owe self-employment tax on that. Okay, let's talk about health insurance for a minute here. So business owners are entitled to what's called the self-employed health insurance deduction if they're self-employed, a partner in a partnership, or a greater than 2% S Corp owner. They can purchase it through the company or themselves, but there's some really tricky rules, especially for the S Corp. Once again, I'm not trying to make you an expert on this, but just recognize where they get their health insurance from. If you're looking at, their spending and where their money is going, they may be getting a subsidized health insurance plan. And this will show up Form 1040, Schedule 1, Line 16, which is the self-employed health insurance deduction. Look for that. I see it all the time missed on tax returns. For an S Corp, your HRAs and the new QSERA HRA, unfortunately, S Corp owners are not eligible, but that's another method that business owners can get some of their health insurance costs paid for. If someone has a lot of medical costs, the C Corporation is the best option for that. And we'll get into that in tax planning here in a minute. A lot of times having multiple entities is the best way to do this. And using a C Corp can be very beneficial, especially if they have a lot of medical costs. All right, disability. You all should probably be familiar with the pre-tax versus post-tax, how you pay for disability impacts when you receive the benefits, whether it's taxable or tax-free. The big question here on this slide is, do they really need it? Ask yourself, what happens to their income if they become disabled? If they have a business that they're running that have a lot of employees and they're not the primary, salesman or cook or whatever, their income may continue on without them. So keep that in mind. At least ask the question. It shows that you understand that they're a business owner and that they may not actually need it. What they may need is key person insurance, disability on someone else that is the key person. A lot of buyout provisions of operating agreements and shareholder agreements will dictate that if someone gets disabled and can't return to work for 6 months or 12 months or something, that the partners or the company has to buy them out. So there's a lot of things to look for in disability. I'll give a little advertisement here for our sponsor, Low Load Insurance Services. They did a great webinar on July 9th of last year on disability and other insurance planning for business owners. So check that out. It's on their website. Okay, life insurance, same thing. You need to ask what actually is going to happen if the business owner dies. You know, I joke here at Blue Sky, I tell them, look, certainly if you want to, you know, take the afternoon off and come to my funeral, but show up the next day and keep doing what you're doing. You know, there's a plan in place, and the company will not collapse. And I think you'll find that in a lot of arenas. So you want to look at not just the personal consideration, but what happens to the business, the impact on the partner or other shareholders. You may also want to have life insurance to fund those buy-sell agreements, where either it's another owner buying it or the entity repurchasing it. So there's a lot of considerations surrounding the use of life insurance for business owners. Property and casualty, another big one. All those risks that we talked about in the first couple of slides under insurance, this is where this comes in. You know, typically, a business owner will have a BOP, a business owner's policy, or some places call it a business owner package, that's going to bundle a bunch of coverages. Things like liability, casualty, vehicle, business interruption, employee practices, cybersecurity. This is a huge one today. If they have sensitive data or a medical practice or something, making sure you have coverage to cover that. And of course, product or professional liability insurance. I'm amazed at the number of product manufacturers that I come across, and they don't even have product liability insurance. If their product hurts somebody, they're completely exposed. So before I leave insurance, one comment, make sure that the business owner is using an insurance agent that works with business owners. It's not something that nothing in State Farm agents, but it's probably not something that your local State Farm agent, maybe they started with them, but a lot of times they outgrow them. You need an insurance broker that's familiar with multiple types of risks for business owners. It's also where a good asset protection attorney can also help if they have significant worth in their business. It's not a place to skimp on. Good solid insurance coverages are a must for a business owner, not only for the liability, but frankly for the legal bills. Most of the insurance companies will vigorously defend their clients against lawsuit. All right, let's talk a little bit about investments. Okay, so most business owners, if they're do have a business that's worth something, it's going to be very concentrated in that business, very lopsided, their net worth kind of leaning over with the value of that business. Make sure you're putting that business value on their balance sheet. I can't tell you how many clients come in and we're talking about it, that maybe they came from another firm and the other firm never, they're like, oh, that's nice, you own a business owner, you know, how much money can you put in your portfolio? Make sure you acknowledge and put that value on there. It's an asset that's been invested in and it needs to be tended and grown. One of the big questions is, okay, do you take that into account? Okay, well, they're in a small cap company. Should we not have small caps in the portfolio, or they have so much exposure to this industry? Should they be all bonds in the portfolio? I mean, there's no real answer to that, but have that conversation. Take into account the net worth of their business. Don't just ignore it. Encourage them to get a periodic valuation so that we're not guessing. There's so many tools out there. If they don't want to get a full-blown valuation, there's so many tools out there today that you can use to get a quick valuation that's better than nothing. Also track the growth of the company. This is where the valuation comes from. Look at the growth in value from year to year. Maybe it's not growing, and they don't know that. The net worth, maybe it's not growing. The flip side of that is it can be the best place to invest. We happen to charge a flat fee at Blue Sky, so we don't really care where the money goes. As fiduciaries, we shouldn't either, but I'll give you a perfect example. We had a client that had a concrete company, and he was able to get these huge jobs based on these big concrete pumper trucks. They pump the concrete instead of pouring them. And he figured his ROI on each truck was like 25% a year. And so my advice was go buy some more trucks. And so sometimes the business is the best place for that, those excess funds. You remember that dual strategy in the first couple slides. Don't completely ignore the portfolio, but sometimes that business is the best source of growth for their money. Help them grow the net worth outside their business. That's the focus. Is to help them grow it outside the business. Don't let them roll every dollar back into it. Real estate investor, real estate business people, they're the worst for that. They loathe to take any money out and do something else. We already mentioned this, but encourage them to become financially independent conventionally, outside of their business, if not already. Get their passive income. So financially independent to me is pretty simple. When your passive income from rents and real estate, dividends, interest, businesses that you don't have to show up to, when that income exceeds your living expenses, you are financially independent. You'll also see maybe a few more with large taxable accounts, and tax efficient investing sometimes can be a bigger issue for business owners than maybe employees that most of their net worth is in their most of their net worth is in the retirement type accounts. Seem to have missed, oh, there it is, real estate. Okay, I double clicked somewhere. I knew it was in there. So real estate, a lot of times the first place you see owner occupied, they're in a building, they want to own their own building, the company is great place to start. Make sure it makes business sense. We had a case the other day, one of our clients in Atlanta was looking at buying a building, and the cost of the buildings were so much compared to what they were paying in rent, it just didn't make sense. But it can be a great place to start. The tax advantages, shifting of income, the FICA benefits. You can have your children working over there, have them own the thing. There are a lot of considerations, self-rental, the 199A, things like that to be careful for. So make sure you know what you're doing there, but it can be a great way to get involved in real estate. I've also noticed a trend. A lot of business owners have an interest in additional properties and investments. So just keep that in mind. It kind of dovetails with being a business owner. Okay, let's talk about some tax. Tax is a big thing here at Blue Sky, and not only for individual investors, for business. So we're not going to try to turn you into business tax preparers here if that's not what your firm does. That's fine, but there are some key things as their advisor that you need to understand how it works. So first of all, some of the basics here, looking for things. Where does the income come in from a business owner? Obviously, line 1, their wages. Schedule C, if they're sole proprietor. Schedule F, farmers. Schedule E is where your partnerships and S Corp comes in. Here's one, line 3A and B, where your dividends come in. So a C corporation, as you know, pays its own tax, but the business owner can take out dividends, and so they get a 1099 div, just like if it was from Coca-Cola or something. So keep that in mind. Schedule 1, line 14, 15, and 16, that is your self-employment tax here, the self-employed retirement plans, and then the self-employed health insurance deduction there on the new Schedule 1, line 14, 15, and 16. Here's your 1040. Everybody's seen that. You know where the lines are. Line 1 coming in there for the wages. And of course here, line 10, the qualified business income deduction. Those are all clues of where some of the more prominent business income items show up on the 1040. So you definitely want to make sure you know where to get those from and how to interpret those numbers. Okay, let's talk about the Schedules K1. A lot of your business owners are going to be S Corps or partnerships, and they issue a Schedule K1. They're slightly different. They're both called Schedule K1, but one from the S Corp, from the 1120S, it's a little bit different than the one from the partnership 1065, but suffice to say they break out the income into a couple of places. Ordinary income, any rental income that the company receives, the deductions, what are called separately stated items. So things like charitable contributions, dividends, interest, those type of things get passed through on that K1 to the 1040. And then of course, distributions. Box 16 on the S Corp K1. This is a number you don't want to miss. This is the money that they're taking out of the company that is not wages, not benefits, not tax-free benefits or perks, things like that. So you want to make sure you know where to find that on the K1, because that can be significantly larger number than the W-2 line. Also on the 1065, at least, I didn't put it on the slide here, but box 14 talks about self-employment income. So a partner in a partnership who is considered a general partner or manager is going to have self-employment income flowing through on box 14. And that's really important that you understand how a business owner, how their income is classified as self-employment income or not self-employment income. It can make a huge difference in their tax. So here is an 1120S K1 for you, just so you can see there. 16D, shareholder distributions. 17V, this is a critical place. This is where all the information for Section 199 comes in. If you're not preparing the tax, it may not mean a lot to you, but if you're interested, that is where all the information comes from the company so that the individual taxpayer can compute their 199 deduction. As I already said, it comes in on line 10, Form 1040. You've probably all been 1099 to death, but it is an entire briefing on its own, but it is so important. I can't tell you, maybe it'll get a little bit better this year, but for those clients that we prepare taxes in-house, but for those that we don't, I can't tell you the number of 2018 returns that came through that either it was missed, not calculated correctly, or they lost a huge opportunity to optimize it. We have a client that makes $6-7 million a year from their company, but pays very low wages. And as you probably know, at the higher levels of Section 199 income, you have to pay 50%. It's based on 50% of the wages is the limit. And so just by tweaking their salary, we were to save them several $100,000 on their taxes. So understanding how that 199 works, if they have a preparer, you'll know best how to handle that situation. But suffice to say, a lot of it is not being handled correctly, and we can play a valuable role in making sure that they get the maximum deduction from that. Okay, business income tax. Like I said, if you don't do taxes, don't want to turn you into a business tax preparer, but you have to learn how to read at least the minimum of the K1. During that data gathering, I like to see you get the whole return. If you can't get the whole return, at least get the K1 and understand what you're looking at. If you do get the whole business tax return, balance sheet is the most important thing on there. Understand what you're reading, understand what debt is owed, understand the assets of the company, at least the book value. The balance sheet will also have things like shareholders' equity and some other different things. So familiarize yourself with that. The second thing I want you to do is take a look at that business tax return and kind of have an understanding of how the company, what I call, translates a dollar of revenue into EBOC. So EBOC is the term that I like to use, earnings before owner compensation. So it's get everybody else paid, get the rent paid, get everything done before the owner takes any benefits, any salary, any distribution, anything. What is that number? And then that's where the real tax planning for a business comes in, is how do you divide that number up? How do you sparse that out? And so as a financial planner, you want to understand how the company does that and what is that EBOC that is available to your client, the business owner, because that's the real number that you need to understand for cash flow, for what they're spending. And if the business was to fall on hard times or they want to get out, that's the number that you need to replace, is the EBOC. Okay, this is one of my favorite slides. We're going to spend a few minutes on this. This is something that I came up with when you have a business owner, unlike an employee, an employee shows up to work and they, oh, here's what you get paid. And certainly they can go lobby for a pay raise, but I don't think many employees are going to ask for less money. With a business owner, like they can set their salary within reason, pretty much whatever they want. And so there are different reasons that you would pay yourself a different amount. And so I've listed some of the ones here that you'll want to consider when working with a business owner and how to determine what to pay themselves. And I'm telling you, this is great stuff. Most business owners don't do this. Most CPAs don't do this at all. So strategy number one, minimize payroll tax. This is the most common one I see. Obviously, you'd pay yourself no salary if you could. Now that you can't do that because of number 4, IRS reasonable compensation, at least for an S Corp. Of course, if you're a partner in a partnership, an active partner, all of your income is subject to payroll tax. But theoretically, to minimize payroll tax, you want that salary as low as possible. Same thing if you have a big company and you're trying to maximize the qualified business income deduction, you would want to pay yourself as low a salary as possible. The case I just mentioned with a company that was making all the money, they were not maximizing their QBI because they weren't paying enough in salary. There is a formula, so the optimal number, it works out if you do all the math, is about 27.9% of the net income of the company should be paid out in wages to maximize the QBI deduction. It's really a fascinating calculation if you have nothing else to do to replicate that. Of course, the IRS has a minimum fair market value salary for an S Corp. It's one of their areas of focus. If you're trying to maximize Social Security, of course, there's no incentive to go above the wage base, which for 2020 is $137,700. A spousal 401k is one of my favorite strategies. Once again, if you're under 50, pay them $21,115, subtract out their portion of the Social Security Medicare, and it leaves you $19.5 to put in a 401k. Likewise, that are above 50, that number is about $28,000. There's no reason to, unless you're trying to follow one of the other strategies, which is like maximize Social Security benefits, these are the numbers that optimize that particular salary. Once again, if they have a new comparability 401k with profit sharing, there's no point in paying over $150,000 salary unless one of the other exceptions applies, because they can't get anything more than $57,000, which is the deferral plus the profit sharing match. Same thing if they have a cash balance or defined benefit. No point in paying them over $285,000. They're maxed out at that amount. Some of the other considerations, when we do the strategy planning, the salary, we come up with this great plan and we say, okay, business owner, you need to pay this in salary and put this in your cash balance plan and put this and do this and do this. And they're like, well, I need $500,000 to live on. Or, hey, our business doesn't have that much money. So that's one of the things keep in mind is you have to take into account what they need to live. We already talked about the owner-occupied building and the fringe benefits, but once again, they have complete control over their salary to some extent, and so you want to make sure you have a strategy for what you're paying them or what they're paying themselves, and not just a random number. Okay. Some simple tax reduction strategy concepts. Number one, structure beats deductions. Some business owner in December calling you up saying, hey, I need some deductions. What are some things I can do? Like they've completely missed the boat. You got to structure your business, structure your life, beats deductions. Utilize multiple entities. We already talked about that. Pre-tax, your lifestyle, do things on a pre-tax basis. Shift income to children, shift income to different lower, a C Corp taxed at 21%. Don't be afraid to shift income. Now it has to have a purpose. The IRS, step transaction doctrine and some other things. I mean, there has to be a business purpose for it, but you can come up with a business purpose pretty readily. The sole purpose of that cannot be to avoid income tax. Same thing, change the character of income. Change wage income to distribution, change wage to rental income, change the character to a lower rate of tax. Effective tax rates for business owners under the new tax reform in the mid 20% are absolutely possible. I don't care, people making millions of dollars utilizing multiple entities in some of these strategies, you can get that number into the mid 20s. Section 1202 company is a special kind of C corporation that you can actually take the money out of the C corp tax free after 5 years. It's a really complicated area of the code, but if they have a CPA, have them ask about it. It's a great opportunity. Charity, this is one of my other favorite ones. Myself and a lot of my clients are very charitably inclined. Way better to give through the business's advertising or sponsor something. This weekend I went to the Heart Ball, the American Heart Association. Way better for Blue Sky to sponsor that Heart Ball than to me to write a check. Calculated about $2.17 of wages is required to make $1 contribution, as opposed to just give them $1 from the company, sponsor something. There are some limits on that and a special limit for C Corp. All right, let's move to retirement saving and income planning. I know I've said this already, but don't forget the business. When you're doing retirement planning, don't get fixated on just the portfolio and saving and those traditional things. What's the strategy for the business? What's the value? Model that thing as a lump sum or a stream of cash. And of course, don't forget, if they do sell it, how the tax is going to work on that. Make sure you're using an after-tax number. But it's absolutely vital that you do it. And it shows the client that you understand the business has value and what they're trying to do. Now, at the same time, if they're more self-employed and it doesn't have any value, you may want to make sure you're tempering any optimism for what the value is. Although we had a self-employed wedding coordinator who retired recently and effectively sold her business for 1 times revenue. So most businesses have some sort of value if you get creative about it. Social Security, Medicare, this is another really fun area that you want to get into that as planners we should be experts on. Most owners are taught to minimize their salary, get an S Corp, pay yourself as low a salary as possible to save FICA taxes. So then they walk in your door and they're 60 years old and maybe they never built that big business and they're still kind of self-employed and they have like no Social Security. I see this all the time. It's actually kind of sad. There is a strategy to maximize those benefits. Make sure you understand what bend points are. The bend points in Social Security when the percentage of replacement changes. For sure, sometimes that third bend point, which is the last 15% of Social Security, if they paid themselves a really low amount, that's not it's hard to maximize that. You really got to pay a lot, but certainly make sure they're getting all that second bend point. Replacing 0 years later in life or low earning years from when they were a teenager at age 60, there's a return on that money when you look at the Social Security benefit they get if your higher earning years are all packed in towards the end of your career. If you go out and maximize the Social Security earnings, at age 25, I dare say you're probably never going to get paid back that money. But if you're really piling it on, in your last couple of years, you do get paid for that. And don't forget about the spouse, especially if you have a non-working or low-wage spouse. That 50% spousal benefit, it makes a huge difference. So make sure you're looking at their Social Security and tweaking that salary if there's an opportunity there. I've done a whole 5-part series on retirement plans. Make sure you're familiar with the pros and cons of each type of retirement plan. This is pretty basic CFP stuff, so hopefully everybody is familiar with that. The last bullet there, employee census data and cash available. Once again, it doesn't do you any good to do the greatest planning. Oh, you should have this 401k with profit sharing, with cash balance and all this, if you don't look at how much cash they have to fund these things, or the employee census data. Not asking you to be an actuary, but just have a general sense of, hey, my client is the youngest person in the company. A cash balance plan may not be the best for him. All right, succession planning. They can walk away, they can actively work and grow, they can own passively, family transfer, transfer to employee, third-party purchase. Once again, each one of these is a seminar in and of itself, but just be familiar. I just want to give you a list of some of the options of how to do succession planning for a business owner. These are just some of the key options that you can use. Okay, wrapping up here, estate planning, similar to the insurance agent, estate planning for a business owner, you probably want to be working with an estate planner that works with business owners. This can get really, really complicated. All right, so the first thing, make sure the property titling is correct. You know, sometimes you're going to want things in the non-business owner spouse's name, varies by state. Obviously check with the lawyer, but it's something that you want to look at. Ask them, hey, I noticed everything is joint property. Did you talk to your lawyer about this? Just make sure you're considering how the property is titled. It can be very important, not only for asset protection, but estate equalization. With the estate exemption so high today, some business owners are still going to be affected by this. So make sure you understand what the value of that business is. Of course, all business owners need their standard estate planning documents, but you're going to want to make sure that they have advanced documents that help them with asset protection, you know, LLCs, trusts, you know, different types of companies, things like that, and also documents that address the succession planning. Once again, I understand you may not want to become an expert in all this, but if a business owner walks in and all they have is a will and a power of attorney and a living will, and their business is worth anything whatsoever, they do not have adequate estate planning. So make sure that either you're doing that planning or you get them to an estate attorney that knows what they're doing. As I mentioned already, the estate exemption for a couple is up to over $23 million this year. If it has that type of value, you absolutely need a plan. The liquidity, either using life insurance, a partner buying them out, giving it away prior to dying to children or something, a third-party purchase. There are two what I call mulligan IRS sections, section 6166 and 303, that can be used if a business owner did not do any planning and they died prematurely. Those are sections that can help mitigate the estate tax issue. Don't forget state taxes. A few states still have state estate taxes. So when you're doing the planning, just because they're not over the federal limit, make sure you know the state rules. Some of the transfer techniques to effect transfer, of course, the operating agreement, shareholder agreements may have it. They may have a separate buy-sell. Some people put in their trust, ESOP, employee stock ownership plan, family LLCs or partnerships, gifting. Why is this important? There was actually a case recently. It wasn't my client. I was just reading about it, where the client's attorney drafted this awesome trust. I mean, it had exactly what he wanted to do in the business and all this stuff that was going to be for his children or whatever. And nobody looked at the operating agreement of the company. And the operating agreement said that it went to the partner. And so make sure that you're looking at all these different mechanisms and understand which one takes precedence over the other. Or if you don't understand, make sure there's an attorney involved that does understand, because it can get really, really complicated. If they're selling it, make sure you understand the difference between an asset versus a stock sale if they're selling their company. All right, so in summary, business owners are very different for the most part, but the same principles apply. As I said, if you recognize that, my briefing followed the CFP board learning objectives for the CFP program, the ones that apply. So the same principles apply, but just get familiar with the nuances. To me, I love this stuff because it's the fusion of complicated tax, risk management, estate planning concepts. Some firms don't really do a lot of that, or maybe that's not your thing. Make sure that you have professionals involved that are very fluent in those type of things. And then my last bullet point there is, If you offer to save a business owner time and can provide a solution to a problem, they will pay you, and they will pay you a nice fee for it.